then you can boost the economy. I would tell you that if you like what you see or hear today and want to keep going on your learning journey after today, our next webinar will be on marketing. It'll be coming up in March, and we would love your feedback on what you'd like to hear about. So feel free to tell us through the chat window what you would like to hear about. Now, I'm going to slide in here, one slide. If you want to contact us through email, we've given you 2 email addresses here, and then down at the bottom of the page is my cell phone number in the lower left-hand corner. And as I said, we'd love to hear from all of you and any questions that you have. Right now, Dolly, why don't you bring up the answers to poll question number 1, and let's see who we have in the audience. So it looks like most of the people who are in the audience are business owners, and secondly, people who work for privately held businesses, and then a little bit in the category of the other category. Welcome to all of you, and I appreciate you coming. I appreciate your interest. I hope you find what you need when you look through this webinar today. We're going to go to a second poll question about what brings you here today. And while you're answering that poll question, let's flip to the next slide, which is the agenda for today. And in terms of the agenda, we're going to start out with why you might want to buy a business, how to get started with buying a business, how to actually go through the process of buying, tools that you're going to need to do it right, what the role of building teams is all about in doing acquisitions well. Now, what you have to do or be prepared for once the deal is done. And then we want to get your input at the end today on this webinar and also additional webinars that you would like to see through the 2022 season. And then finally, we will have a little information for you at the end on ways that we can help you. So, Dahlia, why don't you bring up the answers to poll question number 2, and let's just learn a little bit about each other. So in terms of what brought people here, most of it was that they've bought one or more companies and they're looking for more information, followed closely by thinking seriously about doing our first acquisition. So those of you that are in the hunt and eager to be in the hunt, I really appreciate your interest, and I'm hoping that you'll be able to walk away today much better informed. Now let's go take a look at why right now might be a really good time to buy. First of all, in general, why buy a business is because most privately held businesses grow organically. We call it bootstrap growth. So with their internal resources, and that is a really tough way to grow. We find that the owners tend to work harder than necessary. They make less than they could. The companies, they find it difficult to keep up with economic expansion just through bootstrap solutions. There's not enough scope in the business. They can't command enough market share, which means they lack pricing control. The companies struggle to get the right resources in place. They can't add talent fast enough, which we think is going to be especially problematic over the next few years as the workforce continues to tighten down and the competition rises. And then lastly, the company doesn't add enough knowledge and falls behind its more nimble operators. The second reason to look at look at acquisitions instead of bootstrap growth is a timing issue. And right now there is a widening gap between buyers and sellers. So sellers are represented this light blue line up here. Buyers are represented on this dark blue line down here. And the reason these two lines are separating is because the baby boomers are aging out. They have more businesses coming on to the market, the selling market every day as they run out of time and want to cash in their chips. At the same time, that means that there are fewer baby boomers as potential buyers, followed by the next generation, Gen X buyers, who actually, for the most part, have passed their peak buying numbers. There are still baby Gen Xers who are buying, but the numbers are smaller. And the last group, the generation behind them, the millennials, we're waiting for them to build the financial muscle so they can actually come in and be a force. We think that that curve will start to turn in 2023, but it still will be a long stretch until these curves come to cross, if at all. And one of the things that I want you to just be aware of is that when there is a widening gap between the sellers and the buyers, it becomes a buyer's market, and that can create real opportunity. Now, let's take a look at the next poll question. Dahlia, if you want to throw it up. And we're going to ask you to weigh in on what do you see as some of the biggest risks or challenges for buying a business. And here you can check as many of them as you want. Figuring out how to get started, identifying the right high potential targets, figuring out what makes a good fit, knowing what makes a good deal, knowing which deals to pursue or avoid, correctly defining value, um, knowing the steps to go through acquisition, and knowing what to do after the deal closes. So check as many of those as you think apply, as you think about doing your next acquisition, and what are the things that you worry about. And as you guys are working on that question, I'm going to go down to the next slide. And we're going to talk about questions that I get a lot, which is how to get started. And these are some of the most common questions I hear. We're going to take them one at a time. The first one, who to work with. To get started, I would recommend you reach out and put onto your team an attorney who has experience in doing deals. So you don't want a real estate attorney who's going to refer you out to someone else. You want someone who actually does buy, sell deals regularly. You want an accountant, and this is someone who is very good at tax as well as valuation work. You want a banker. A broker could be helpful, although the field of brokerage does have some mixed bag to it. And then one of the things that I think we don't think about enough is just people who know people. So a lot of deals come up through just word of mouth. Next, where to look. I would recommend pulling lists, going to industry forums, going through your personal and business connections, just looking up websites, companies that come up in a search for industries you're interested in. And one group that most people don't think enough about is their employee population. And it'd be amazed how many employees might know of something that might be interesting to look at if only you involve them in the question and answer problem. Who do you contact? My advice, go for the owner. The owner's the one who's going to make the decision to sell. Why start anywhere else? In terms of how do you make contact, you send a confidential letter, you can make a phone call, you can see an email. Just be careful however you do the approach, because a lot of business owners may not be clear with their employees that the business is for sale. They may want to keep it confidential. In terms of what you say, I get asked this one a lot. And I generally would suggest you start with, I'm looking for businesses to buy. Maybe you know someone who knows, maybe you might be looking or interested in talking. And I'd like to have you reach out to me if you know someone, or I'll call you to reach out and make a connection, and we'll see where the conversation goes from there. I think a very general approach like that is not particularly threatening. You're going business owner to business owner, and hopefully you can make contact and get an introduction started that way. In terms of how to finance it, I will tell you the good news is that the SBA is open for business. They like doing transactions like this. You're going to need anywhere from 5 to 20% down, and you're going to need all costs to operate and pay off debts is going to have to be less than 115% of total revenue on the deal. So you got to make sure that the deal can work, and it can work monetarily as you work your way through the transaction. So with that, Dahlia, do you want to bring up the answers to poll number 3? So when you guys talked about what do you see as some of the biggest risks, the biggest one was knowing which deals to pursue or avoid and correctly defining the value of a potential acquisition. A lot of them got checked. I would say in third and fourth place, identifying the right high potential targets and knowing what makes a good deal. So again, thematically following the same. pathway, and then knowing what to do after the deal closes was also really important to people. We're going to get to all of those answers just as we've started in here. So as I answered these questions about how to get started, obviously it is this simple, although it may seem like more work than that. If you're looking for help or trying to figure out how to do this, just send us an email or put your information in a chat and ask the question. We'll be happy to get to you either at the end of the webinar, we will be taking questions, or to take it one-on-one after the webinar if you want to get more specific. Now, let's talk next about how to buy a business. And we're going to, in this slide, we're going to give you an outline of the next section of the webinar. We're going to talk first about focusing on real potential. Then we're going to take a look at what we call the Wheel of Fortune. We're going to talk about finding the right deal and then watching out for deal killers. So in terms of focusing on real potential, as you start to look, make sure that you've got the right deals in front of us. And you have to make sure that the person that you're dealing with on the other side of the table, the seller, is realistic about the current value of the business. Surveys show that most business owners actually overestimate the value of their business by 50% or more. And we will come back to that issue a little bit later, but it's a real problem when it comes to getting a deal done. You also want to be willing to, you want to have a business owner who's willing to transact with outsiders. So has this owner come to terms with the likelihood that a family member or an employee won't be a future owner? And then finally, you want to talk with someone who's prepared to do the deal now. So they're not just shopping, they're serious about moving on, changing their relationship to the business, and or letting go of the business entirely, and that they also have control of the business and can convey that business. So we'll talk about that a little bit more as well. Secondly, once you've answered the three basic criteria questions positively, so they're realistic, they're empowered, and they're ready, then you want to work through what we call the Wheel of Fortune. And we're going to start up here on the upper right-hand corner with a proven track record and a go-forward plan. Once you know that this company is on the market, that's the very first thing that you want to ask for is there historical information? Now, I will tell you, even to get your hands on this information, you're going to have to sign an NDA, a non-disclosure agreement, potentially a non-compete agreement as well. That would be something that you and the seller would agree to. And once you've turned that in, then they'll start turning documentation over. The next question you want to ask, once you can see, yeah, this business is in business, they do have plans to go forward with the business does have a future to it, then does the company culture fit with yours? And next to that is how similar are the client profiles. So in here, I've seen a lot of deals fall apart post-deal, either because there's a total clash between the acquiring company and the selling company in terms of the people, the way they think, the way they work, the way they act and behave, or because the clients are very dissimilar. So you pick up a whole bunch of clients that are paying half the price of what your clients pay for a service that might look at least similar on the surface. You're going to have a hard time trying to bring that group of clients up to your price point. Or if your clients find out that you're offering a lower price point, they may start demanding that. So you've got to be really careful about both the employee culture and then the fit of the customer profiles. The next thing you want to look at is cross-selling ability. So what I mean by that is either products, services, the mix of customers, yours and theirs. Can I sell what I have to the other company? Will the other company have any interest in buying what I have? That gives you a multiplier effect once you get the deal done. Next, you want to look at the infrastructure and personnel. This is a great reason to be doing acquisitions right now. What kind of infrastructure, personnel, skills, talent, capabilities can I pick up that will help me make a leap forward? Then expandability opportunities. So can your business expand with the help of the acquisition more than it could do on its own? So can you pick up more geography? Can you do more product or service development? Can you enter new markets based on what either company knows how to do? Would be the questions you'd be asking in this box. And then finally, can you reduce your cash flow risk by boosting revenue and gross profit and cutting out expenses? So does the model actually work when you put the two companies together? And what you want to do is work your way around the wheel. Well, so let me back up a question. So first you work your way through these three questions, which is realistic, empowered, and ready. And then once you do that, you want to work your way through all of these pieces of the wheel and make sure you've got yes answers in every one of the wheels here. Okay, now, next slide, finding the right deal. You also want to look for a money machine. This is ideal. This is a company that consistently produces cash year over year, and there's no reason to believe that that will stop once you do the acquisition. The second is a moderate risk, moderate reward approach in terms of looking at the opportunity to expand. And that takes in a whole bunch of stuff: revenue, profit, customers, capacity, products or services, geography, markets to go after, and then intellectual capital and workforce. So when it comes to risk, I really want to caution you, it is not a game of go big or go home. I would rather see you take moderate risk or even smaller bets, even if you have to do a series of smaller bets to get where you want to go. You will probably do a better job of managing the risk of digesting and integrating the acquisition. Um, and make sure that you really understand how you're going to pay off the deal and put money in the bank as you go through the digestion process. And one last thing down here, there's no surprises. I can't emphasize that enough. When it comes to business owners who keep coming up with surprises, steer clear. Don't get sandbagged. You want to be dealing with an honest, upfront seller as you go through this process. Now, now in terms of getting the deal done, I've also got a slide here on some common deal killers that we've seen. And you want to watch out for these examples. They're certainly not the only ones. First one, look at the SBA and other loan covenants and make sure that the company's assets are not tied up against loan covenants that aren't going to clear because there isn't enough money in the deal to get the deal done and pay off the loan covenants. I think this is going to be a particularly interesting conversation over the next few years as we talk with small businesses that have taken on the 30-year idle loans. And they're going to have a very slow pay down rate on a very large loan. And how does that factor into actually getting access or getting clear title to the business? The next one, real estate loans versus property value versus promissory notes. So if the seller also owns property, whether or not it's part of this deal, make sure that the property liens don't attach to the business. I've seen that a couple of times where we get close to finalizing the deal, only to finally get our hands on the promissory notes on the property or the clear title access for the company to find out that there's a lien on another piece of property that we're not going to be able to clear out here. You also want to look for hidden stakeholders and other interested prior parties. This could be an employee, a vendor, a customer, a family member, somebody who either has a formal written or informal agreed to right of first refusal to the business. So someone that is going to get preferential treatment and stand in line ahead of you. You don't want to do a whole lot of work on a deal and then find out that you're going to get shut out once you've gotten close to doing the deal. As you write an LOI, so an LOI is your letter of intent. We're going to talk about that more later. Make sure that you are clear about how the covenants commit your actions as you work your way from the beginning of the deal to finishing and contracting the deal. And then whatever else you do, don't educate potential competitors who might pull out after you spent a lot of time talking with them about what you're going to do with their company. Keep your thoughts and your plans close to your vest. I know that as business owners, we all love talking about the potential for our business. We love creating ideas, looking at opportunities, but you want to make sure that you don't go down the path of sharing a lot of information with the seller until you have a contract in hand. Now, this next section, once you find a deal that does interest you, you're going to start working on the tools that you need to do the deal right. And before you want to make an offer, you want to do some digging into your target market acquisition candidates. And by the way, all of these tools should come from the seller, but don't be surprised if your seller doesn't have some or all of these in place. Remember, you're dealing with entrepreneurial companies. They're informal. They tend not to have everything on paper. Um, and you the lack of documentation shouldn't necessarily scare you, but it should cause you to be more careful in the due diligence that you're doing. Clearly, the more that information you get, the more you'll be able to lower your risk, and the more that you're able to lower the risk, then the more likely you would be willing to pay a premium, or if you can't get the information, the higher the risk premium you're going to charge. And don't expect to get any of these, just like on the previous slide, until you've signed a non-compete or non-disclosure form with your target. So the tools that you're looking for are evaluation, a detailed roadmap, locked-in key players, loyal customers, KPIs, key performance indicators, a growth plan for the business, a forecast, which does what-if modeling, and these tools are going to help you really evaluate the quality of the deal and what you would do with it. Now, we're going to take these one at a time. So start with evaluation. And as I said earlier, surveys show that owners tend to overestimate the value of their business by 50%. And when it comes to looking at evaluation, don't just settle for an email that says, hey, I was told that the value is X. You want an actual valuation report to look at. And that is independent data. Ideally, it would have improvement suggestions on it. It will define the assets and liabilities historically over a 3-year period. It would look at the cost of replacing the owner. It would compare purchase options. So if you did an asset versus an equity purchase, for example, and then you want to be able also to line up multiple valuations if you can, so that you can assess multiple businesses. So don't just try and do a single deal, but shop and look at multiple deals. You also, as you start to look at different opportunities and you're trying to make sure that you're chasing the right deal, you want a detailed roadmap, locked in key players, loyal customers. So we're going to take you through these 3 pieces. And while we're doing that, Dahlia, why don't you bring up the next poll question? And on this poll question, I'm curious, for those of you that have tried to do a deal and had it fall apart, could you check any boxes that applied? The seller wasn't realistic, seller advisors were too hard to work with, didn't trust what you're being shown, concerned that staff and the seller wouldn't stay on, worried the clients might leave or wouldn't be profitable, the seller was ever over leveraged, couldn't get out from under the debt, didn't think you could afford to do the deal, or something else, and check whatever applies on there. Now, in terms of the tools, you are going to want a detailed roadmap. So you want proof of performance. What has this business done at the very least over the last 3 years? You want to look for a turnkey operation. So what is that? It's highly documented. It has people well trained to do the work. It has the equipment in place that is needed to do the work. And you just would walk in, turn the key, and the machine would start up the day you take over. As I said, highly documented and then replicable, so you can expand it out without a lot of effort. You also want locked in key players. So the employees may have been committed to the old owner, but are they going to be committed to the new business that they're going to be engaged with? And there are ways to lock in key players. They can be paid a performance bonus for staying on for a period of time. They can have a structured settlement with the other company. There are a variety of ways to get employees locked in with the other company so they don't quit before the deal. And then you're also going to have to take a look at what you're going to do for them post deal to keep them locked in. But you don't want to lose the most important talent. And so you have to look at who are the most valuable assets in this business. And that's what you're going to use your searching around as you're looking to try and figure out. And then how committed are they and how can I keep them more committed? Then on the other side, the same questions for customers. But in this case, you also want to make sure that this seller has customers who appreciate and are willing to pay for the value that the company produces. So if the company really, their value paradigm is simply low cost provider, that's not going to be very sticky. There's got to be something else to the deal, why those customers stay around and keep coming back time after time to this seller for what this seller provides them. On the next slide, some of the other tools that you want to look at would be key performance indicators. So this will help you to assess historical performance of the company, benchmark the company against the industry, understand what grows value in the company that you can use to then focus on when you take over. And it will help you also set goals going forward and give you some measures that you can use to then have your team demonstrate improvement as they take over. In terms of the next slide, you want to review their growth plan. So the seller should have come to the table with some form of a growth plan. If they don't have that, they really, I question how committed they are to actually making this sale work. You want to get the seller's view on what needs to be done going forward, what's realistic given the current resources of the business, suggestions of where else to take the company, and then any kind of market analysis or projections that they can provide to back this up. And not everybody has it, but it's really valuable and it should boost your confidence and your willingness to purchase if you can get your hands on it. So let's take a look at the answers to that poll question number 4 and see what some of the issues were. So biggest issue that came up was that the seller wasn't realistic about price or terms. Man, I'm not surprised by that at all. I would say that as we work on helping our clients find the right deals, that is probably the biggest issue we run into. And we use the valuation to sort it out. We actually go out and get people to turn in a valuation right away so that we know if they're in the market. Secondarily, I didn't trust what I was being shown. So I will tell you, you want to use tax returns. And if you start getting stories about, well, here's the tax returns, and then there's other stuff and the records don't match, you're not going to give them credit for what's not on the tax return. The other boxes also did have weight. They were too hard to work with. You're concerned about the commitment of the staff or the clients, and then over leveraging was an issue, and on occasion didn't think I could afford the deal. So thank you for sharing that. This last slide in this section about tools to do it right, you want to, if you can, get your hands on a forecast. Play what if. Even if you have to work with the client to formulate this, you're going to need to have this becomes an essential planning tool for the business. And it is based on historical reality, so it shouldn't show that we've grown 5% a year for every year, but now we're going to grow 50%. That doesn't work. And at the same time, you don't want to see that they've grown 5%, 5%, and then they blew up to 50%, and now they're projecting 50% going forward. Not unless there's real good evidence that that could happen. You want to look at the future opportunity of the business in terms of markets, customers, employee intellectual capital that's being put to solving the puzzles of the business. And you use this to evaluate the degree of risk, and you also use it to lay a foundation for the future. So here's a good understanding of what this business is capable of doing. Now, in this next section, we're going to talk about the importance of building teams. And there's 4 different teams that you're going to work with as you go through the deal. The first one is going to be the search team. The second is the acquisition team. Then comes the takeover team. And then finally, the implementation team. And most of these people can come from people you already know, your employees and your advisory team. My advice would be, as you're getting ready to do an acquisition, get your company overstaffed before the deal gets underway, so that your takeover team and even your acquisition team can step away from their normal duties and help you out in working through these processes without feeling like they're trying to be in 2 places at once. In terms of the search team, these are going to be some of the job descriptions for this group. My recommendations here are, don't waste your time on talk with the seller until you see evaluation and know you and the seller are in the same ballpark. So back to that question a minute ago about sellers weren't realistic. And then once you have gotten an idea that you're probably in the same valuation ballpark, then spend time and invest time in getting to know the seller. Invest in conversations. Find out if you can work together. And this is where your search team can be really helpful as they search for and qualify candidates and assess the fit. As I said a little bit earlier, make sure that you ask your search team to come up with multiple opportunities rather than just one. That should boost your chances of choosing the right deal for you. So this search team is going to have good communication skills. They've got to be insightful. They have to be able to take a little bit of a jaundiced view on things. So lean into the information that they're being given and assess the truth about it, and then figure out whether or not it's going to work in your environment. Next comes the acquisition team, and this team usually transitions in once you sign the non-compete, non-disclosure agreement. And this team is going to be doing a lot of analytical and legal work. They are going to work with your attorney on the letter of intent. So I would consider your business attorney part of this acquisition team. The letter of intent is an offer in writing. It is a formal legal document. You ask your attorney to prepare it. Don't use anybody else's. It should be a few pages long. If you are just testing out an attorney, you can actually ask them to send you examples of LOIs so you can look at them ahead of time and get an idea of what they look like. The next phase, due diligence, this is where you dig deep. So you're prepared to make a formal offer. So if I go back to the previous slide, your search team came up with some companies. They said, we've got a bunch of information. We think these companies are worth looking at. We really think that you ought to focus on these. You now have turned in a letter of intent. You have access to much more information. You're digging into the company and figuring out, are you really going to proceed forward to make a formal offer? Make sure that you do have in this stage qualified analysts ready to go into the company to assess everything. And you have to keep in mind, you may have to do this confidentially. So the employees may not know that the company is up for sale, in which case you usually go in looking like you're a potential customer kicking the tires of the company before you hire them. You also want to make sure you have someone on the team who can do tax planning and look at the most tax advantaged way for you to complete this transaction. And then you're going to go to a contract of sale. This is a lengthy legal document. Again, this is going to come from your attorney, and it is much longer than the letter of intent, and it details the exact pieces of that will happen in this transaction and how the transaction will actually be executed. one of the things I would say is as you go through these steps, it takes months to get through these steps. And I would caution you that people have gotten deal fatigue. By the time they get to the stage of the contract of sale, they just want to get it done. They just want to cave, saying, hey, let's just get it over with. That's the wrong time. You've got to preserve your energy and do well getting through each of these stages. And then finally, the last stage for the acquisition is the post-sale verification. So once you have a signed contract, then you are going to have usually anywhere from 30 to 90 days and a holdback amount in the contract to go in and verify that everything that was supposed to be turned over in the contract has actually been turned over and there are no holdbacks because something is missing. You're going to have to be very conscious of that time frame. It's best, I think, to have the acquisition team that laid out what's going into the contract of sale, what's being purchased, actually doing this post-sale verification. Now, next comes the takeover team. So you actually bought the company, and the takeover team needs to step up and step up quickly. So this team needs to have been formed before the acquisition actually took place and be ready to go. They should be talking with and working with the acquisition team, and they should be ready to take over. This group needs good communication and people and accountability skills. And you want to free up some of your best, most experienced personnel for the takeover. If all goes well, you're going to make money by doing this. If you do this stage poorly, you probably are going to lose money. And I will tell you that surveys of companies in the Fortune 500 say that typically what happens, they spend a lot of time on the acquisition and not nearly enough time on the takeover. So as you go through the takeover team is going to want to connect with clients and prospects, make sure that they're locking in key personnel who are still there, securing the assets of the business, so the bank accounts, the customer list, the vendor list, the intellectual property, how things are done, procedures manuals, all of that is they've got their hands on it. They want to get into the reporting systems of the company. They also are then going to have to go in and educate incoming personnel. These are the people from the seller's company who are going to become your employees. You're going to have to teach them about the practices of the new company. They're also going to have to look for redundancies and make sure that they get the right people into the right seats on the bus. And they're going to have to begin to integrate teams from the seller's company to the buyer's company, get everybody working together. And then one of the other things they are going to have to do, and this does take analytical skills, is test the timeline to get to profits. So up to now, there should have been a forecast of what this deal is going to look like and how long it will take to pay the deal off. Now they're going to be getting their hands on the business. They want to make sure that that timeline works, or if it doesn't, that they're giving an early warning on what has to be done in order to match whatever requirements you have for the deal to work. Then after you get done with the takeover, the implementation team steps in. And this may be people that have come off of the other teams, the acquisition team, the takeover team, and it may be some additional players. And this team should be ready to stay on for a year if needed. And here's some of the things that they're going to be working on. They're going to define and control how the debts are paid off. So there's a schedule and they're in charge of making sure that happens. They're also going to ensure that the numbers that are coming from the work that is happening with this company under your umbrella are bulletproof numbers. And that's both on the planning side as well as the reporting of what's happening. They're going to winnow and build an outstanding client portfolio. So what do I mean by that? Here's a great opportunity to let go of some bad customers, whether they were the seller's customers or your customers. You may not need to keep 100%. Focus on the really high quality ones that you can build a future business on. And then if you have an opportunity, dump some of the ones that are closer to what I would call the bottom feeders. This team is going to settle on the product and service initiatives for the business going forward. So what business are we going to be in? What are we going to pursue? giving direction both to production and to sales and to marketing. We want to make sure that as they do their work, what they're doing is getting the right people into the right seats on the bus. And everybody has a fit and they know their job and they understand their job and they're working towards completing the tasks that are assigned to them. They also are going to want to design a 5-year growth map with goals and key performance indicators. They're going to be responsible for implementing accountability. So everybody in the company, individuals, teams, groups, all understand what they are accountable for and they are being measured and managed against those accountabilities. There, this group is going to want to also plan for up and down markets. I don't think I have to say a lot about that, but here's the example. Somebody that did a deal way back in January of 2020 might not have had a down market plan that would have dealt with what happened as a result of March and April of 2020 and COVID arriving. And you've got to really be thinking about, if things go well, that's great. But if things don't go well, how do we survive and make sure that this deal doesn't founder or land on the rocks or take our company down with it? And then finally, this team is going to weed out any redundancies, whether it's people, products, customers, services, whatever. The implementation team is really charged with building one team and one focus. And what that means is we want standardized job grades, standardized job descriptions. We want a common bonus structure and review practices so everybody understands that they are on one team. You hopefully will be able to build some collective goals and drive that down to the individual level. You're going to have open reporting with team meetings. So we want to share information broadly. We don't want people feeling that there are conversations happening over in the corner that they don't understand what's going on over there. We want shared wins and shared rewards and a common culture. And that common culture happens because of inclusion. Once you get through the initial takeover and take control phase, this is all about building a unified company out of the old and the new, and everyone is focused on going forward. Now, this is going to be your last slide. And this is about building your management team. So now this company has to go forward either as a separate standalone entity from your company or combined together within your company. It's now just a larger company. You want to make sure that you have expertise in each discipline. You're able to run a business twice the current size. You have the capability and the expertise to do that. This is now time for a multi-year focus to ensure that the next several years of this deal really pay off. You want to build a team that can produce growth in revenue and profits while making the company more efficient and effective. You want self-sufficient, responsible leaders, teams, and individuals. You will have tried out people from the old company to find out who's capable of being responsible, being a leader, being self-sufficient, and you'll combine that with people that you had on your teams, and then probably with some outsiders who are brought in to supplement what you need. You also want to make sure that you put in place training for the whole company. You want to get better every year at what you do, and every employee in the company should have some form of a training program. You're going to go back to that key person handcuffs. I mentioned that way back in the beginning. It comes all the way through here to the end. So make sure that you know who are the people you really cannot afford to lose, and that you make arrangements to incent them to stay on and think really hard about going somewhere else. This is going to be especially important over the next few years as we continue to see the workforce tighten up. And then you do want to have a very active growth and replacement recruiting program. You want to be able to bring people in when you need them and not get stuck because someone does leave or someone turns out not to be a fit. You have to remember this is a marathon, not a sprint. You cannot do this alone. You're building a much bigger, more valuable asset in your portfolio. And sometimes, as you're looking on something bigger that you haven't done before, it might feel overwhelming. But at the same time, as you work your way through, you've got a team of people to support you. You should be able to get through it. So, what I'd like to do now is I would like to just go to our next slide and ask you to help us out. And Dahlia is going to bring up a poll question, and we'd like to know which of the following topics would you like us to cover in the future? Valuations, exit planning, buying or selling a business, the life cycle of a business, how consulting works, developing the next generation of owners, financial dashboards, KPIs for the business, marketing, or any others. If you do check others, just please put a note in the chat what else you might be looking for. And this will be very helpful to us in terms of planning our series of webinars for 2022.